All right, welcome to our technical deep dive on Ind AS 116. This session is really geared towards senior finance professionals and audit partners. We're going to skip the basics and jump directly into the really complex stuff, the implementation challenges, the key judgment areas, and of course, the compliance risks that are built into this standard.
You know, this quote from the ICAI module really gets to the heart of it. It is the bedrock of the entire standard. What it was designed to do was fix the main problem with the old standard, AS 19. Remember how companies could structure deals as operating leases to keep these massive long-term obligations completely off the balance sheet? Well, Ind AS 116 gets rid of that bright line test. It forces everyone to take a substance over form approach, which, gives a much truer picture of the economic reality.
So here's how we've structured our analysis today. We're going to follow the life cycle of a lease right through the standard. We'll start with the foundational principles and the scope, then we'll get into the nuts and bolts of the ROU model, and then, and this is crucial, we'll pivot to the practical side of things, the transition, those high-risk judgment calls that regulators are always focused on, and finally, making sure everything lines up with Schedule 3 presentation requirements.
For the lessee, this was an absolute paradigm shift. Completely. By getting rid of that old finance versus operating lease classification, the standard just took away the option to keep lease obligations off the balance sheet. This new single-model approach means you have to capitalize a right-of-use asset and a corresponding lease liability for pretty much every lease. And that has fundamentally changed the financial landscape, especially for asset-heavy industries.
Okay, so defining the boundaries is always a critical first step. The scope is pretty broad, but how it interacts with other standards, that's a key implementation challenge. For instance, figuring out if a contract for an intangible asset falls under Ind AS 116 or Ind AS 38, well, that requires a really careful look at the control principles within the standard. So let's look at the specific carve-outs now.
The standard gives us some really important carve-outs. Any contracts already covered by Ind AS 115 or 109 are out. But more practically, you have two key exemptions you can choose to apply. One for short-term leases, so 12 months or less, and another for leases of low-value assets. Now, on that low-value exemption, the standard doesn't give a hard number, but the ISB's basis for conclusions gives a hint. Something around $5,000 or less when the asset is new would probably qualify. And remember, this is an asset-by-asset decision, not for a whole portfolio.
All right, let's get into the core mechanics of the standard, the right-of-use model. This is really the engine of Ind AS 116. It's what mandates the capitalization of both that ROU asset and the lease liability, and this all happens at the commencement date, which is the day the lessor actually makes the asset available for you to use.
So the ROU asset itself, it just represents your contractual right to use the underlying asset. And while it definitely feels a bit like an intangible asset, Schedule 3 is very clear. You have to present it within property, plant, and equipment. It's so important to remember that we are capitalizing the right to use the asset, not the physical asset itself.
Calculating the cost of the ROU asset isn't just one number. It's multifaceted. You start with the initial lease liability. That's your core obligation. Then you add any initial direct costs like legal fees or commissions, basically any cost you wouldn't have incurred if you hadn't signed the lease. Crucially, you also have to factor in an estimate for dismantling and restoration costs, pulling in the requirements from Ind AS 37. And finally, you adjust that carrying amount for any lease payments you made before commencement, minus any incentives you got from the lessor.
The discount rate is absolutely key, and the standard gives you a clear hierarchy. Your first choice is the rate implicit in the lease. But let's be practical. To calculate that, you'd need to know the asset's fair value and what the lessor thinks its residual value will be, information a lessee almost never has. So what happens in practice? Well, in nearly every real-world scenario, companies have to use the second option, the lessee's incremental borrowing rate, the IBR. This example from the ICAI's materials really just shows the straightforward math of present value. The hard part, the real judgment call here, isn't the calculation itself. It's figuring out that 12% discount rate in the first place. Getting the IBR right is so critical because it directly determines the size of the liability you put on your books on day one. Now, after day one, the accounting for the asset and the liability goes in different directions. The lease liability is amortized using the effective interest method. The ROU asset, on the other hand, is typically depreciated, usually over the shorter of the lease term or the asset's useful life. The exception is if the lease transfers ownership or has a purchase option you're reasonably certain to exercise, then you depreciate over the asset's full useful life. And, critically, don't forget the ROU asset is also subject to impairment testing under Ind AS 36. This change in how we recognize the expense is a huge departure from the old straight-line rent model. When you combine straight-line depreciation with the front-loaded interest on the liability, you end up with a total expense profile that's highest in the early years of the lease. This front-loading can really hurt your net profit in the first few periods of a new lease portfolio compared to how it worked under the old standard.
Let's shift gears and talk about one of the most complex parts of the standard, the initial adoption. Honestly, the transition to Ind AS 116 was a massive project for most companies, and the choices that were made back then, especially around the practical expedience, have had really long-lasting effects on financial reporting.
And just to lock in the timeline, the mandatory effective date was for annual periods starting on or after April 1st, 2019. So for a typical company with a March 31st year-end, their date of initial application was April 1st, 2019.
So companies had this huge choice to make on transition. You could do the full retrospective approach, which meant restating your comparative financials. It was, technically pure, but it was an operational nightmare. Unsurprisingly, the vast majority of companies went with the modified retrospective approach. The key expedient there, setting the ROU asset equal to the lease liability on day one, was just so powerful. But the biggest win was that you didn't have to restate prior period numbers. You just took the cumulative effect of the adoption and booked it as an adjustment to your opening retained earnings. Okay, now let's turn our attention to the areas that require significant professional judgment. For both auditors and the finance teams preparing the accounts, these are the spots that get the most intense scrutiny. And that brings us right to the heart of audit risk. For any audit committee, the big question is always, where can significant estimates be influenced by management bias? Take lease extensions, for example. Management's assessment of whether they are reasonably certain to exercise an option can massively change the liability you recognize. Ind AS 116 is just filled with these kinds of judgment calls.
These right here are the real hotspots for audit scrutiny. First, the IBR. Auditors have to challenge its components, the risk-free rate, the credit spread, any asset-specific adjustments. Second, the lease term assessment. This isn't just about what you intend to do, it's about the economic incentives. Auditors are going to want to see evidence to back up that reasonably certain claim. Third, just identifying if there's a lease hidden inside a larger service contract. Fourth, variable lease payments. You have to distinguish between payments that depend on an index or rate. Those get included in the liability, and those linked to sales or usage, which are just expensed as you go. And finally, ROU asset impairment. That's a frequent target for regulatory reviews.
Finally, let's talk about the output. All this technical accounting work has to end up being presented correctly in the financial statements. And that means following Division 2 of Schedule 3 of the Companies Act to the letter. So this gives you the practical mapping right to the Schedule 3 balance sheet and P&L. Your ROU assets, they go under PPE. The lease liabilities are shown within borrowings, and it's absolutely critical to get that split between current and non-current right for any kind of liquidity analysis. Then in the P&L, depreciation on the ROU asset gets grouped with your other depreciation, and the interest piece of the lease payment gets classified as a finance cost. You have to follow this format. It is mandatory.
This really brings us to the final, and maybe the most important question for any CFO or analyst. After all this accounting transformation, how does it actually affect the way we analyze a company's performance and financial position?
The impact is absolutely profound. Think about it. By taking rent expense out of operating costs and replacing it with depreciation and interest, EBITDA, your earnings before interest, taxes, depreciation, and amortization, gets a significant boost. At the very same time, by adding huge lease liabilities to the balance sheet, your leverage ratios, like debt to equity, increase, often quite a bit. So understanding these impacts isn't just an accounting compliance task, it's fundamental to strategic financial management, to how you allocate capital, and to how you communicate with all your stakeholders.